Well, they finally did it. Japan has started dumping U.S. government debt. What's up, guys? I'm nobody special, and a couple of days ago, I made this video about how the Bank of Japan had conducted a check in Forex market and how that could have been a precursor to the Japanese government dumping our U.S. government debt, and how that would come at a very bad time because the Federal Reserve is engaged in quantitative tightening and interest rate hikes, including that big 75 basis point hike we got yesterday. Well, last night at 4 a.m., it looks like it happened. The Japanese central bank started selling their US Treasuries in order to buy their own yen to prop up their failing currency. With that, we are going to shrink my big melon of a head, and here is the story, folks. Today in Reuters, Japan intervenes in FX market to stem yen falls after BOJ keeps super low rates. Dated this morning, the BOJ keeps ultra low rates, their dovish policy guidance, but Japan's FX diplomats said they took decisive action. Confirmation of intervention sends dollar sliding over 2%, and analysts doubt whether Tokyo can keep propping up the yen. Japan intervened in the foreign exchange market on Thursday to buy yen for the first time since 1998 in an attempt to shore up the battered currency after the Bank of Japan stuck with ultra-low interest rates. The move sent the dollar plunging over 2% to around 140.3 yen to the dollar, after trading more than 1% higher earlier on the BOJ's decision to stick to its super loose policy stance, bucking a global tide of monetary tightening by central banks who are fighting soaring inflation. We have taken decisive action in the exchange market, said Vice Finance Minister for International Affairs Masato Kanda, responding in affirmative when asked if that meant intervention. Analysts, however, doubted whether the move would halt the yen's prolonged slide for long. The currency has depreciated nearly 20% this year, sinking to 24-year lows, largely as aggressive U.S. interest rate hikes pushed the dollar higher. And you can see that here on this chart. This is the value of the U.S. dollar as measured against the Japanese yen. And here we go, right around 4 a.m. Eastern time last night, the U.S. dollar took a nosedive against the yen, dropping very fast. It paired some of those losses and then came back down again, trading awful volatile today. This is as the Japanese central bank was selling their U.S. dollar reserves to buy yen. That has the effect of driving up the yen versus the dollar in order to save their failing currency. The yen has been an absolute free fall this year. And again, you can see that on this chart. This is the U.S. dollar index, or the DXY, often referred to as the Dixie. And right there at 4 o'clock, you can see the Dixie started heading lower before pairing those losses. Now, the Japanese yen is the second largest input to the Dixie calculation behind the euro, which has the biggest influence, but still a big drop in the dollar against the yen will cause the DXY to head lower. Now, this comes at a very bad time for the Federal Reserve and for the U.S. banking system, because a lot of folks in the banking system are already sounding the alarm about liquidity in U.S. Treasury markets. Right now, there are way more sellers of U.S. Treasuries than there are buyers of U.S. Treasuries. When there are more sellers than buyers, that drives the price down. Remember, with bonds, the price and the interest rate are inversely correlated. When the price goes down, the interest rates go higher, and the U.S. economy is dependent on cheap, easy debt in order to keep this massive asset bubble alive. So now you can add the Bank of Japan to the ever-growing list of sellers of U.S. debt, which are driving these interest rates higher. You've got the Federal Reserve is engaged in quantitative tightening, so they are a net seller of bonds. You've got China is a net seller of U.S. Treasuries, and now you've got Japan is a net seller of U.S. Treasuries. 10 years ago, those were the three biggest buyers of U.S. Treasuries, one of the reasons why interest rates have been so low for so long. So if all the big buyers are now sellers, who's left to buy them? Well, the answer is you. Your 401k, your pension, even your banks are now the biggest buyers of U.S. Treasury debt, but with an ever-growing list of sellers, it's not enough to keep up, and so interest rates continue to rise. This is very bad for stocks because American companies are dependent on cheap debt. For years, they've been borrowing money cheaply in order to fund stock buybacks, in order to keep money-burning operations alive longer than they should have been. So as interest rates rise, this is putting pressure on U.S. companies and the stock market. Now, I just want to emphasize that most experts agree that this will have only a limited impact on the value of the yen and therefore the dollar, because Japan only has about $1.3 trillion of U.S. Treasuries available to sell in order to take this action. Now, there's still no word on how many U.S. Treasuries were sold, how many dollars were dumped to buy yen yesterday, so it's possible that this big move was really just a psychological reaction of other investors to the news that Japan was actually doing this, and not the direct result of that actual intervention itself. But whatever it was last night, there is only so many dollars that Japan can dump. Japan cannot print their own dollars. So they only have that $1.3 trillion pool to draw from. And when that is empty, they can't do any more. Meanwhile, Japan has decided to keep their interest rates at this ultra low level. And that is what's fueling inflation in Japan. And that's why the value of the yen keeps dropping. The only way to stop this decline of the yen is to raise interest rates in Japan, something they have thus far refused to do. So instead, they're taking this temporary action of intervening in currency markets to try to save the yen. It's not going to work. It's only going to delay the inevitable. So what does this mean for you? In the short term, this is bad for stocks because this is going to further drain liquidity from the Treasury market, which is bringing us even closer to the possibility of a banking crisis. And also in the short term, this might actually be good for commodities because a lower DXY means things like oil, gold, silver, things that are priced in US dollars will be heading higher as the denominator gets smaller. But again, that will only be a temporary effect on commodities because what the Bank of Japan is doing is not enough to stop the decline of the yen in the long term. Till next time, live small and dream big.